Hi, welcome to this presentation on Introduction to Charting. This video is brought to you by Alpari. Charting is something that Forex traders spend a lot of time. Charting, technical analysis is something Forex traders really tend to specialize in. I would suggest more than just about any other market. Now, charting is pretty simple. What we're really looking at is price movement over time. What that means is that you have a graph with two axes on it. So you have time down here on the bottom, and you've got price up here on the side, on the vertical axis. Now, what's going on here is that we're just looking at price movements over time as they change, and we're making buy and sell decisions based on this information. What we see from a historical perspective, what we see going on right now, how we're planning to control our risk, where we're looking for our profit objectives, stop losses, etc. Much of this decision making is done by looking at the charts. Now, charts are pretty simple. What we're typically looking at is just where have prices been and where are they right now. Now, what I just drew right here, this is a very simple kind of chart. It's a line chart. And by the way, you can use line charts. It's perfectly acceptable. But it's much more common to use another kind of charting model. Rather than using lines, what most traders will do is they'll use a chart that graphs for every period that they're charting, whether they're charting periods every 5 minutes, every hour, every day. Very common to have daily charts or hourly charts. What they want to know is what was the price range during that period, what was the open for that period, and what was the close to that period, and what was their relationship to each other. So let me give you an illustration. The problem is, by the way, with a line chart, all you know is your close price. So it's just a connect the dots, more or less. It doesn't give you that additional information. If we were looking at a chart that showed us that additional information, we would use one of two formats for that. So we typically use a vertical line. That shows us our trading range. So up at the top, that's the high, and that's the low. So whatever the high price was during that period, during that day or hour or whatever charting period we're using, that's going to show us at the very top what that high was, and at the very bottom what the low was. Now, you'll also typically see with bar charts, for example, which are very popular, you'll see a little tick over here on the left-hand side for the open price, and then you'll see a little tick up here on the right-hand side for the close price. So close up here, open down there. Now, this bar chart, this is a Western style chart. It's very common. A lot of traders do like it, and there's some analytical methodologies that are based on bar charts and the formations that appear with bar charts. Now, most Forex traders, however, take this a little bit further, and they'll use candlestick charts, which are very similar to this. The big difference is these are extended beyond the central line, and you get this little candle looking formation. So we have what's called in the middle here the body, the low, the high. These are both the shadows of the candle, not the wicks, by the way. So these are the shadow, upper shadow, lower shadow. We still have our open price here and our close price here. And depending on the color of the candle, so if this candle were red, this means that we actually opened up here and closed down here. So a red candle would indicate that that over that period prices dropped. Conversely, however, we can also get candles that are green or clear, depending on your charting, the way that you've set up your charting package. And in this case, our open price was down here, and our close price was up at the top because we've got a green or a clear body of the candle rather than a red one or a black one. Now, what this does is it encapsulates a lot of very detailed information in something that we can see very quickly just by glancing at it. I know immediately, was there a big price range? Was there a small price range? How big was the body compared to the price range? Were we up for that period? Were we down for that period? I don't have to look at any numbers. I know exactly what it is when I'm looking at it, which is why they're so popular. Now, amongst these three types of charts, bar charts, candlestick charts, line charts, there are actually other charting models that are used much less frequently. These include point figures, which are X's and O's and don't account for time. A little bit more unusual way way to look at it. And there are other Eastern and Western charting methodologies that you can use, but typically what I advise is to get familiar with the most popular. These are very descriptive, they're easy to use, and from here you can branch out into all kinds of analytical tools looking for different candlestick patterns, bar chart patterns, etc. that can trigger trades for you. Now here are a couple of other tips when you're beginning to use charts. Tip number one is simpler is going to be better. Now you will hear this all the time from experienced traders. The more simple you can make your analysis, the more successful you're going to be. It just makes things a lot easier. I always call it ornamentation when you'll see traders with very complicated charts, lots of indicators piled on there, different exotic charting patterns and models, etc. It doesn't really impact your trading overall. Simpler is a lot better because you're not going to be distracted by a bunch of garbage charted all over your charts. Lots of times experienced traders will call it analysis paralysis, where traders who have just dumped lots of garbage on their charts, lots of studies, etc., are frozen into inaction because they get no clear indication of what they should be doing. Number two is get yourself educated. Now you do that in a couple of ways. Obviously, Alpari has a great series of videos to introduce you to some of the basic concepts behind technical analysis, fundamental analysis, etc. But there is no replacement of being in the live market. If you don't want to put money at risk, no problem. Paper trade, experiment with the charting patterns, experiment with charting periods, short-term, long-term, etc., and across different investing instruments. So there is no replacement, and it's one of the fastest ways to really learn and start to apply what you've learned in the market with real money and making real profits. Now, finally, number three is to make sure that you match your time frame to your trading style. What that means is, if you want to be a long-term trader, which is a great way to be, I tend to focus on long-term trading myself. That means that, am I looking at the 5-minute charts? No, not really, because it doesn't have any impact on me. I know that there's going to be a certain amount of volatility in the 5-minute charts or the hourly charts, but it doesn't matter to me. Conversely, if you're a short-term trader, are you spending a lot of time looking at monthly charts or quarterly charts, getting a look at the really long secular trends? Well, probably not. You're probably spending a lot more time looking at the 5-minute charts and the hourly charts. So make sure that you're not trying to make decisions on trades that last months on the hourly charts, or trying to make decisions on trades that may only last minutes or a few hours by looking at weekly charts. It's really a matter of where am I spending my analytical time to accommodate the kind of trading I'm trying to do and that I enjoy and I like and feel like I'm good at.
This video has been brought to you by Alpari.